Okay, so Chapter 14 is long-term liabilities, and they talk about different types of liabilities. We're going to focus on two major ones in here, mortgages payable and bonds payable. Mortgages payable are where you have a payment that includes both the payment of the interest that is owed as well as some of the principal payment. It's what we call a self-amortizing loan. So on page 547 there, you can see an example of a mortgage payable. Now, I want you to know how to do this and how it works because a lot of people don't realize how much interest they're paying whenever they buy a car or a house. And most consumer loans work this way. So what I want to do is go through and set up this little amortization table. You're going to need to go through and know how to calculate one of these and know how to do the journal entries. So it's helpful for the test, but it's also helpful for you in your personal lives. So what you end up with is you end up with a date, payment date. They start off with the unpaid balance at the beginning. You won't have that in the homework and on the test. I don't think I have this column in here. You don't really need it, but it's okay to put it in there. So this is the unpaid balance at the beginning. Then you have the monthly payment. And then you have the interest expense. And then you have the reduction in debt. This is how much you're actually paying off. And then finally you have the unpaid balance at the end, which is really what you need. Unpaid balance end. Now the way it works is when you first open up a loan, it would be like the 0 month, or in this case I'd call it 0 month. It's June 1st in the example that's on page 547. You borrowed some money. You went out and you borrowed $100,000. Now, you don't pay any interest when you first borrow it. These loans, the interest is paid at the end of a period. So since this is paid monthly, you're not going to owe any interest until you make your first monthly payment. So there's no interest due. But then what happens is we go to our first payments down here, and that's going to be on July the 1st. Now, in this example, we carry the $100,000 over here to the unpaid beginning balance. You wouldn't need to do that. You just need to know that what you owed at the end of the period was $100,000. The bank has already told you what the payment is going to be. They've told you it's going to be $1,200. And they did that by running an amortization schedule. That means if you keep paying this $1,200, eventually, when you get to the end, you'll have paid all the interest and you won't owe anything. There's no amount due. So that $1,200 is your payment. But you know some of that $1,200 is going to pay interest and some of it's going to reduce the debt. The question is, how do you tell how much is which? Well, the interest calculation is pretty simple. If you remember, the way we calculate interest is going to equal your principal times your rate times your time. Well, that's what we're going to do here. The amount that we owe, the principal, was the $100,000. So we owed $100,000 because for the last month, that's what we've been borrowing. So we owed $100,000. The rate that we're going to use here is 9%. And we divide that by 12. That gives us that 0.75% on column C. And then again, we divide it by 12 because it's monthly, so I'm showing the full amount, 9% divided by 12. If we take that calculation and multiply that out, that gives us $750. So that's how much we're paying to borrow the money. The loan payment's $1,200. So what we end up doing is the difference must be then what we are paying off on the debt. The $450 really comes over here and is subtracted from here. And that gives us a new unpaid balance at the end of this month, $99,550. Now when we come over here to the next month, the second payment, this would be August, we're going to do the same thing again. Only now, instead of using $100,000 that we owed, we don't owe $100,000 because we paid $450. So we're going to take the $99,550 and carry it over. Our payment stayed $1,200, but now when we calculate up what our interest expense is, it's not going to be quite as high because we already paid just a little bit of it earlier. So we really only were borrowing $99,550 that we paid 9% for 1 month. So what happens is our interest payment actually went down a little bit. Now it's only $747. The difference, since our payment's fixed, the difference must be that our debt payment or reduction went up just a little bit, $453, and it did. And then we take the $453, we subtract it from here, subtract it down, and that gives us a new number of $99,097. and then we would just keep repeating that. The payment would stay the same, but over time what happens is that the outstanding balance goes down towards zero, and as it does that, the expense that we're paying in the interest goes down because we don't owe as much, and our principal payment, our debt reduction, goes up over time. So in the first payment, you're always paying the highest interest and the lowest reduction in debt. As you go down, that switches, and at the end, you're paying higher debt reduction and less interest because you don't owe so much. So this is how our house loans and our car loans work, okay? Now, for you, this is an example of how a bank would do it. Now, how would you record this? Well, let me erase this for a second. Let's go down here and do the journal entry. So, bear with me. The journal entry on the day that we bought it, let's just do that one, June 1st. We got cash. Actually, we didn't get cash, did we? Yeah, we did. It says we got cash. So we got $100,000. And then, or land, maybe we got land if it's mortgage. We got an asset. And then we have, I think it's, yes, mortgage. We have a mortgage payable liability of $100,000. So that shows that we owe the money and we got an asset. We got the cash and used to buy an asset. On July the 1st, we make our first payment. That's when cash goes out. Well, that's where it's important to know what these pieces are, because these pieces here are the journal entries. The easy one's the cash. Cash went out the door. We wrote a check, so it's credited for $1,200. But that got split into two pieces. Part of it was for mortgage interest expense, because we had to pay the mortgage and pay the bank for borrowing the money. The mortgage interest expense is right here. It's the $750. The $450 we need difference right here. It's a debit because we have to balance. That's what's reducing our balance. So if we started off with a big credit, here it is, of $100,000, the way we make a big credit go down over time, because we want it to go to zero as we pay it off, is we hit that big credit with lots of little debits. So what we're going to do is we're going to debit it with $450 for the first payment. So that's going to be mortgage payable. And we're going to keep doing that each month, and this number here, the expense number, is going to go down. The mortgage payable debit's going to go up until finally we've made all of our payments. So that's how a self-amortizing mortgage loan works. Okay? So you'll need to be able to take care and do one of those on the test. Okay? And you also should be familiar with the journal entries that you need to do down here. Over on page 549, I start talking about bonds. Bonds payable are the way most companies get money. They sell bonds to investors who then promise to give them cash, and then the company promises to pay it in the future. The difference between a mortgage loan like this and a bond is that the mortgage loan includes payment of debt as you make your payments. A bond doesn't. It's interest only until you get to the end of the term, and then you have to pay the full amount. So there's some definitions you might want to know over on page 548, 550, 551 about different types of bonds. But really the key thing you need to know about bonds is that there's two interest rates. There's the face rate and the market rate. And the reason that's important is because people think bonds don't change in value, but they do. They change based upon the market rate, because the market rate's always changing. So I'll give you an example. Let's assume that you have, it's today, and you have a bond that pays a face rate, face interest rate of 6%. Now that face rate is a contract. That's what the interest payment's going to be based on. So if it's a $1,000 bond, they're going to pay 6% a year. They're going to pay $60 to whoever has that bond for however many years it's outstanding. The face rate never changes. What changes is the market interest rate. Now in this case, let's assume we're going to sell this bond, and let's just assume that it's set at 6%, because normally that's what happens. You try to set the face rate of what you're going to pay close to what the market rate is. So in this case, let's say it's the same, all right? Well, that works out really well. This is what we would call a par value bond. Now this isn't par like stock. It just means that it's trading at the face value or the par value, okay? But what happens is over time the interest rates change. So let's say that we go 1 year in the future. So it's 2000 and this is 2014, so let's go to 2015. Our face rate didn't change. But what did change was the market rate. The market rates went, say, they went up. Now what people don't realize is that because the market rate is changing, that can change the value of the old bond, the used bond. Because this bond is still paying 6%. It's going to pay 6% for however many years it's outstanding. It never changes. So now new bonds are paying 7%. Well, the only way I'm going to get somebody to buy my new bond, let's assume that my bond before was worth 1,000. That was the par value. Was 1,000. And so the fair market value of the bond was 1,000. Well, the par value is still 1,000, but nobody's going to want to pay me $1,000 to earn 6% when they can earn 7% on new bonds. So they're going to pay me some lower amount. Let's just make up a number. Let's say $975. I'm going to have to sell that bond at a discount. So I'm going to have a discount bond. So I don't sell the bond. I decide I'm going to keep it. I don't want to sell it. So I wait, and then go for another year. The economy turns around, and now my bond, which is still paying 6%, is paying there. But in the meantime, the market rates have gone down. So now the market rates are paying 5%. My bond is still a par value of $1,000. That means if I hold it until the end of the term, I'm still going to get $1,000. But in the meantime, if I want to sell it early, that bond now is paying 6% when other bonds are only paying 5%. Well, now I have what's called a premium bond. I have a bond that people want because it's paying a higher rate. And so the premium bond is going to sell for a higher price, maybe $1,025. So what people don't realize is that the fair market value of used bonds that have been issued go up and down based upon what the market rates do. And so that's one of the most important things to keep in mind about bonds and finance is that market rates determine the value of your bond. So they move opposite. As market interest rates go up, the value of existing bond, the prices, bond prices, go down. They go the opposite. Or, as that's what happened here, as the market rate went up from 6% last year to 7%, my bond went down. I had to put it on sale at a discount to get rid of it. On the other hand, if the market's rates go down, then the value of my old bond's going to go up. So bond price goes up. They move opposite. So this is the most important thing about bonds is keeping in mind that as the market rate changes, the bonds go up and down. The reason that's important is because when companies sell bonds, oftentimes the difference between when they vote for the face rate and what the market was at that time and they actually sell it, the market rate can go up or down. So oftentimes they'll sell a bond at a premium or a discount. Okay. And so that's where we're going to go now is over at taking a look at what happens when we sell a bond at a premium or discount. And that's over on page 552. Now, again, when we use the word issue, we're talking about selling a bond. That means a company is getting cash, but it's also getting an obligation to pay that money back in the future, as well as to pay the interest in the meantime. So what's going to happen is we go through, let's talk about when we just sell the bond at face value. At face value, the market rate that is in the marketplace and the face rate that the bond is paying are the same. So they end up being, it's not premium or discount, it's a par value bond. That's pretty easy. They have this over on 552 that we got some cash on January 1st. We sold the bond, so the company got $200,000. Let's move this over here. And then they have to pay it back in the future, so they have a liability. Payable $200,000. So that one's not too tricky. But what you need to be aware of is when you sell the bond, not at the par value, but at a premium or discount. Maybe on January 1st, the board of directors agreed to a 6% bond, but between the time it got approved by the SEC and sold in late March, the interest rates had changed, so it either went up or down in value, because that happens all the time on those bonds, because the board of directors votes on the bond well in advance of when it actually gets approved and sold. And the market rate on the day it's sold is what determines its price. So they give the example on page 553 of a company that goes through and it sells the bond, but now what's happened is that the bond has gone down in value. The interest rates have gone up in the marketplace, so the face rate of the bond is lower, it's not worth as much. So it only gets cash of $191,889. But it has an obligation to pay back at the end the full amount, the bond payable. So it's not off the hook. It's still going to have to pay $200,000 at the end of, I think this is 5 years. So the difference must be some number we have to plug in there. Well, this number happens to be $8,111. And that's what we call an unamortized bond discount. Now, what that represents really, in a sense, is extra interest. Because I don't know about you, but if I go to you and say, hey, I need to borrow some money, I need 20 bucks, and you say, well, I'll tell you what, I won't loan you 20 bucks, but I'll give you 15 now if you give me 20 on Sunday. So if I get 15 from you today, and then I pay you back 20 on Sunday, what's that extra $5 to me? Expense, right? It's an interest expense. So that discount is exactly what we have here. So now when we go over and we get ready to pay, because bonds usually pay every 6 months, we get ready to pay on July the 1st, we got to figure out what the bond's going to pay in terms of its interest. We've got to take this expense, this $8,111, and we've got to spread it out over the time that the bonds are going to be outstanding, because we don't want to put all $8,000 of expense in January, because that's not fair. That's not good matching. So we need to spread it out. So every time we have a payment, we're going to take part of this $8,111 and put it into the expense account. Okay? So now we go over to July the 1st, and we have a payment. I think they show the payments here. So let's jump over to page 559, and you're going to see it here. So first thing we do is we figure out how much cash we have to pay. Well, the cash is based upon the amount that we've agreed to pay of our bonds. And our bond amount was, if I remember right, it was $200,000 was our principal. And I think it was 7%. Does that sound right? Yep. 7% was the face rate. That's what we agreed to pay. That's fixed for the whole term. And this is for every 6 months, so we're going to divide it by 2. And that works out to be $7,000. So that's how much we're going to send a check out to whoever owns our bond and we owe that interest to. But the bond interest expense that we have here, that we have to show for the cost of borrowing the money, isn't just the $7,000. It's more, because we've got to take part of this $8,111 and add it in. So what we do is we take this unamortized bond discount, and since we're using the straight line method, which is easier than the effective interest, we take this amount, the $8,111, the amount of the discount, and we divide it by how many payments we had. And we had 10 payments. And so we put $811 right over here. Now what happens is our bond interest expense, we add that up, that's the amount of our expense. And then that entry we're going to use every 6 months. We're going to make that entry, and that's going to go until the end when the bond's due, and then we're going to pay back the bond with the full $200,000. So this is what we call amortization of a bond discount using the straight line method. We find out how much cash we owe for the bonds. We find out how much the discount was, divide it by the number of payments, put it in. Again, we want this number, the bond discount, to go to 0 by the end, so we have a big debit. We make a big debit go down by hitting it with lots of little credits, which is what we're doing here. A bond premium is the same thing, only in reverse. If you go over to 554, you're going to see where we talk about premiums. In this case, when we sold the bond, we got it at a higher price. The market rate had gone down, so we sold it for more, which is great. We got more money. We got $208,530. We're only going to have to pay back $200,000, so it's almost like we got some profit, but we didn't. This is not income to us. What we're doing really is we're going to be paying too much for the next 10 payments, 5 years, so we're basically making people give us the money that we're going to pay them extra over time in advance. It's kind of a weird concept, but it works that way. So what we have is this unamortized bond premium. And so we record that. Now when it comes down here and it's time for us to figure out what our payment's going to be, well, we do the same thing. Now the payment didn't change. It's still the $200,000 times the face rate of 7% divided by 2, so it's still $7,000. But this premium is extra money that we got from them. We're going to use this to reduce our expense. It's like we got the extra money to reduce the amount of the payment because our expense should be less than the $7,000. We shouldn't be paying $7,000. Our expense should be something less. So what we're going to do is we're going to take the unamortized bond premium, and that amount was the $8,530. We're going to divide it by the number of payments, and that's going to be what we have, but since that was a credit, we want to have a debit because we want to hit that credit with lots of little debits. 853. And so we take the difference between these, and that's going to be what our true interest expense should be. So now if you flip over and look at page 653, you're going to see that we really should have $6,147. So even though we're sending cash out of $7,000, that's really too much. So we're going to take $853 of this extra money we collected from them, and we're going to use it to reduce our bond interest expense because our expense should be lower than the payment. We still have to pay the $7,000. That's what our agreement in the bond said. But the expense is really lower than that amount. So that's how we amortize the bond premium. Again, using the straight line method. And then that payment would just keep repeating every 6 months. Okay. I think the only other major thing that's in this section that we probably don't have time, because I think they're going to close this up out of here, would be the calculation for the present value of a bond. I'm trying to see where it is. I lost it. And that's something you're going to have to do. I think I have that set up as a blank page problem currently in the current exam, page 555. So there actually is a digital ink lecture. Have any of you guys used those digital ink lectures? They are so dry. Have you tried them, the digital ink? If you go to the chapter 14 and you go to chapter study resources in that folder and click on it, there's going to be something that says digital ink lecture. So if you click on it, it's basically me talking and writing, not like this with a video, but writing on like a green board. So I'm talking and writing, explaining as you're seeing the words come on. So take a look at that, and that'll walk you through the calculation of the present value of a bond. That's the E4 exercise that you're going to be doing this week on homework, okay? Because we're going to be running out of time to do that. That'll be a blank page, so you'll want to take a look at that blank page problem. The other thing that I wanted to cover real quickly in Chapter 14 are leases. There's two kinds of leases. There's capital and operating leases. You don't need to know the calculations for them, but you need to know what they are. Operating leases are what we're used to, which are where you have a rent for a car or something like that, and so what you do is you debit rent expense and you credit cash. It's a short-term operating lease. It's all expensed up front. Capital leases are where you're making a lease that's so long that you actually end up basically buying the product or the whatever it is, the equipment. Even though it's called a lease, it's still treated as a purchase. So if you look on page 573, they have a list of how you can tell if you have a capital lease. It can't be canceled. The lease is probably as long as the product's going to last. At the end, you can buy it for a bargain purchase. So there's a lot of ways you can tell if you have a long-term lease, a capital lease. If that's the case, it gets to be a lot more confusing because now you have to go through and estimate what the price is that you paid and record the asset, and then you have to depreciate it. You have to record the estimated liability that you owe and record that as a liability, and then you have to take the lease payment and figure out how to split it between the interest expense and the principal payment. So capital leases aren't a bad thing, but they're a lot more work accounting-wise. We're not going to do it here. You just need to know when there's an accounting lease, if it's either a capital or an operating lease. Okay? So that's on page 572 and 573. That's really all you need to know. Don't worry about the rest of the capital leases. Okay? So I think that'll wrap it up. So let me shut this thing off.